Hi, and welcome to Budget Analysis 2021. In this session, we'll be discussing some of the changes made with respect to the withholding regime under the Income Tax Act. My name is Radhika Parekh, and I'm here with my colleague Arijit Ghosh. We're both members of the International Tax Practice here at Nishith Desai Associates. Arijit, would you like to start us off by discussing the withholding changes made with respect to sale of goods transactions? Go ahead.
Thanks, Radhika. Sure. The Finance Act of 2020 last year introduced a provision under Section 206C1H, which introduced a withholding obligation upon the seller to collect from the buyer. This is on the sale of goods that takes place domestically. The government has now introduced a two-way collection system by introducing a very similar obligation on the buyer to deduct tax while paying consideration to the seller. So far as the structural mechanism of the sections are concerned and the materiality thresholds are concerned, they're absolutely the same. The total turnover or the gross sale and receipts of the purchaser in the previous year from when the consideration has been paid needs to exceed INR 10 crores, whereas the threshold for the individual transaction needs to exceed INR 50 lakhs in the previous year from when the consideration has been paid. The tax rate is fixed exactly the same as the previous provision, which is 0.1%. It is important to note that Section 194Q has offered an exemption from the applicability of the section if there is any withholding tax placed under any other TDS or TCS provisions. However, this exemption is not applicable when tax has been paid under 206C1H. So it is important to note that on the sale of goods domestically, 206C1H and 194Q will both apply parallelly. So far as the unanswered questions through this finance bill are concerned, in the previous year when 206CH was introduced, the industry had placed questions about the definition of goods, which was undefined within the section. However, goods has still not been defined under Section 194Q. The Supreme Court had previously held intangible movable property to also fall within the definition of goods. So therefore, whether financial transactions would be covered under the ambit of these withholding obligations remains a little uncertain. The CBDT last year had taken out a circular to say that 206C1H will apply on the transfer of listed shares. Whether it applies on unlisted shares is still unexplained, and whether the CBDT will take out a similar circular to say that 194Q also applies to listed shares is also uncertain at this point in time.
Thanks, Arijit. In addition to the introduction of 194Q, the government has also proposed to introduce sections 206AB and 206CCA to the Income Tax Act. Both these provisions have been introduced with the goal of incentivizing people to file their income tax returns. Specifically, Section 206AB provides for a higher rate of withholding or tax deducted at source on payments made to specified persons, while Section 206CCA provides for a higher rate of tax collection or TCS when payments are received from a specified person. Under both these provisions, specified person has been defined to mean someone who has not filed their income tax returns for both of the two assessment years relevant to the two previous years immediately prior to the previous year in which the tax is supposed to be deducted or collected. And such person has an aggregate TDS or TCS of at least rupees 50,000 in each of these two previous years, and the time limit for filing their return under Section 139(1) of the Income Tax Act has expired. In such instances, under Section 206AB, the person making the payment will have to withhold at twice the rate that would normally be applicable, or at the rate of 5%, whichever is higher. And the same would be applicable with respect to the TCS collected under 206CCA. Now, keeping in mind that these provisions will naturally cause an increase in compliance burdens, because now persons making payments or receiving payments will have to conduct the requisite KYC to figure out whether the person that they're receiving the payment from or paying to qualify as specified persons. The provisions also provide certain exemptions. Most notably, Salary paid under Section 192 by an employer to its employees is exempt from the purview of Section 206AB. Another notable exemption is with respect to non-residents who do not have permanent establishments in India. These individuals will not qualify as specified persons. While this seems like a welcome exemption, it's important to note that there could be a situation where income tax authorities argue that the non-resident does actually have a permanent establishment in India, and therefore the higher withholding tax rate be applicable. In such instances, while the dispute is ongoing, either in the tribunal or at the higher court level, the entity who's responsible for making the deduction would be left without recourse.
So, Radhika, while it seems that the, the objective behind the government introducing these provisions is amiable, the effect that it would have on taxpayers is that it would significantly increase compliance burden. And as we saw in the case of 194Q, it would also increase the tax burden that is currently placed on taxpayers who are filing their returns.
Yes, absolutely. So while the goals are amiable, what the government is trying to achieve seems like a step in the right direction. What's actually happening is people who are filing their taxes are are essentially left out to dry.
Thank you.
Thank you.